Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmur. I'm the Director of Advisory Services here at Creekmur Wealth. I'm joined as always by John Creekmur, our founder and senior wealth advisor. And John, we are actually coming out of the Easter season. I hope everyone had an amazing Easter holiday with their friend and family. But we're going to actually be talking about a different type of egg, the nest egg today. And we're going to be talking about transitioning from having a paycheck to living on your nest egg. And so, John, just kind of big picture, when you think about that concept, what do you think is the most important thing to be thinking about as you're looking to transition from working full time to being fully retired?
Drew, it's so interesting. We have, I'm going to say, just nationwide, probably about 5,000 people that we work with, and of those, I would say my 35 years in as far as in this industry, I have a lot of clients we've helped actually transition from working to retirement years. So we probably have 2,000 clients that have already transitioned into retirement, and so we have this large body of people now that we're actually able to learn from. And I think sometimes what's the financial impact or what's the number one financial thing to look at? I think the biggest thing is a shift mentally.
Right.
It's recognizing that you are working for a living, you're getting a paycheck, and all of a sudden now you're no longer working for a living. It's a big transition. I think psychologically, it's a transition as far as your time,
Yeah.
but all of those things actually play into a transition financially. And if you don't understand the transition and how significant it is, it's going to be difficult to actually change what the purpose or goal of your money is. And so you have to transition what your purpose or goal is with the dollars that you have.
Yeah. Yeah. You definitely do. John, I think a phrase I've heard you use a lot, kind of walking through that emotional transition, is it's not about what you're retiring from, it's about
Mhm.
what you're retiring to. And you need to be very clear about what are you retiring to. And knowing what your life is going to look like was actually going to help inform what you do financially
Mhm.
in your retirement income plan. And that's a really key thing for everyone to be thinking about. Now, John, there's a lot of ground when it comes to retirement to talk through.
Mhm.
And so I just want to hit on a few of the key elements to be thinking about. Can you actually talk about the importance of tax diversification when it comes to
Mhm.
how to build your income plan in retirement?
So much of what we're working through is trying to understand how do we keep as much of the money that individual has accumulated over the years. And there's a lot of different drags on those dollars. One of the biggest drags out there is actually taxes.
Yeah.
And so we have all different types of taxes. We have income taxes, we have capital gains taxes, we have real estate taxes, we have sales taxes. All of those play together. Now, some of them you're limited as far as what you can control based upon where you live. And so if you're in a state that charges higher real estate taxes, and yet you have a lot of family in that area, you may not be able to move. However, from an income tax standpoint, regardless of where you live in all 50 states, you have the same federal income tax code to work in. So one of the things you really want to make sure you do is you have a tax efficient retirement plan. So what that really means is what are the decisions that you can make to decrease overall taxation in retirement? We do want to look at the state. We'll look at your also your community that you live in to make sure we find ways to decrease taxes there. We want to find ways to make sure you're not paying more than what you should in real estate taxes. But the biggie, Drew, is the decision you can make simply from a federal income tax standpoint. One of the things that people fail to recognize is there's different types of buckets of money when it comes to your income in retirement. And by diversifying your dollars in different buckets of money and where you pull your income from, you can drastically lower the amount of total tax that you pay. And what you need to remember, folks, is that one type of income can actually have a compounding effect as far as in taxation.
Yeah.
And so, in other words, if you have income, say you're married filing jointly, and you have income over $108,000, well, then all of a sudden you're going to pay a higher level as far as taxation let's say on your Medicare, as far as your premiums. You'll pay a higher level of capital gains tax. And so it all starts to multiplying together. So, what are the different types of buckets? Well, we have money that's taxed always. So that would be dollars that you have inside an IRA or a 401k or a 403b or some type of workplace retirement plan. When you pull money out of there, that's taxed. You have tax never, so that would be distributions from a Roth IRA. That's never taxed. Or maybe even income you receive off of a municipal bond is not taxed from a federal standpoint. We have tax deferred, and so those would be dollars, maybe an annuity or possibly a life insurance policy if you structure the payment stream incorrectly, in which you're not paying taxes until you pull the dollars out. We also have capital gains tax, and so if you have a highly appreciated asset and you sell it, well, then you're going to be taxed at a certain dollar amount or a certain percentage. It could be 20% or 15% or even 0% based upon the amount of income you have from other sources. And so whenever you're looking to say, I need to have a certain dollar amount every single month, X number of dollars a month, maybe it's 5,000 a month or 10,000 or $20,000 a month of income, which bucket those dollars come from is going to determine what the tax rate is that you pay, Drew. And by structuring things properly and where you actually pull the money from, you can lower the amount of tax, which means that you have fewer dollars as far as gross dollars distributed for your investments, which means your money ends up lasting longer.
And, we always like to say how much you keep is just as important as how much you leave, right? And so at the end of the day, trying to have a well-structured, well-diversified tax plan leads to you keeping more dollars and be able to maybe give charitably in a bigger way, or take your family on more trips and actually live that lifestyle that you want to live. And John, taxes has been a huge area of growth for our firm. We've had a lot of great conversations with folks all around the country that we work with, helping them figure out how to keep more of their hard-earned dollars. Now, John, the other side of the coin, and there's a lot of stuff with retirement, but I want to talk about the issue with two key rules of thumb, right? And those two key rules of thumb are, number one, the 4% safe withdrawal rate, and number two, that a 60-40 allocated portfolio is the ideal asset allocation in retirement. And, John, the issue with just accepting a rule of thumb as tried and true, oftentimes can cost you a lot of money. And what's so interesting to me is the individual financial planner actually created the 4% rule. He actually built the study. He actually just came out with a new paper refuting that own rule. And he said, I never intended for this to become the gold standard and have people base everything in their retirement life around it. Because at the end of the day, you're all unique individuals. And one rule, it's not a one size fits all approach to retirement. And so, John, when you think about those two rules of thumb, what really stands out to you and what's important for people to consider?
Yeah, I mean, rules of thumb are simply starting points of discussion. That's all they are. And so you need to look at your own situation and what are your goal objectives and what you're really trying to achieve. Then once you do that, you want to start using technology and you want to start using really mathematical formulas to help get you to the best decision. So 4% may be too much for one individual and not enough for another individual. That's why we say it's a starting point. It gives you a back of an envelope calculation to say what is a general starting point for income. What you really want to determine is what is the amount of income that you need in the current year, and then what are the variations from that income brought about by inflation or changes in tax laws, or brought about by changes as far as interest rates or in market performance, and then be able to start making micro adjustments as far as the amount of income that you're pulling out. And through what we have built out over the last, I'm going to say 5 to 7 years, is a very robust technology system in which we have all goal objectives from every single client when they approach retirement, 3 years from retirement, and then all the way into retirement. We know what the goal objectives are. You don't have to put one-time purchases in there. So maybe a vehicle or a trip that you have for the entire family. You'll have to put those items in their benchmark for certain dates. Then you have your actual rates of returns, which are calculated every single day. Then we use statistical analysis to tell us when you're starting to violate or getting too close to a risk level. We put guardrails in place, either on the high side and low side. And as you start to approach those, our systems then start to generate out action plans of either giving you the ability to increase your withdrawal rate or decrease your withdrawal rate. And in making small adjustments, maybe it's saying you need to decrease spending by $13 a month or $73 a month. By making small micro adjustments, it makes it much easier to balance over time. And so that's the first step, Drew, is to make sure you use technology to help you make better decisions, more informed decisions. But it's not a one-off, one-time decision. It's being able to analyze that on a continuous basis every moment of every day. Well, that's what our team does for individuals. So that's been a large investment of time and resources to provide tools, and also working with some best-in-class, very bright mathematicians and statisticians on coming up with the best solutions to get the highest probable outcomes.
Yeah.
The second thing you mentioned, Drew, is what had to do with portfolio allocation and the old tried and true 60-40 rule when it comes to retirement allocation, 60% stocks, 40% bonds. Well, what I'm going to call that is that the 60-40 allocation is actually the widowmaker of your retirement plan. I have seen more retirement plans blow up by that type of allocation because it's a static starting point. Most people, they misinterpret what it really is. And so you truly need to have a more broadly diversified risk management plan in place that allows you to allocate money between traditional investments, such as stocks and bonds, international investments, but you're rotating into those different asset classes and sectors based upon what we're seeing on the overall marketplace and in the geopolitical environment that's changing at a faster and faster pace. Then on top of it, you need to start layering in some non-financial type of investments. Let's say real estate is an example. Let's say private equity into small privately held businesses, or even some large privately held businesses. We need to be looking at maybe some option writing strategies, some currency strategies, some commodity strategies that give you broader diversification, because that's how you're going to have a smoother ride as far as in your overall returns. So, Drew, rules of thumb is a starting point of conversation, but we've seen a lot of plans blow up over time.
Yeah, we have. And it's great to have that starting point, but like John said, having technology, having a team around you actually will help you dig deeper and actually make a more informed decision based upon your life and what your goals and dreams are. And John, one of the things you mentioned as a different way to invest in retirement, you mentioned an option strategy. We recognize things changed. And so the last 5 years have been the worst 5 years for U.S. bond performance in the history of the United States.
Mm-hmm.
But we were able to move clients out of bonds to an option strategy that's actually providing an upside of about 49% in the last 5 years. That's been massively impactful for people to be able to continue living that retirement lifestyle they desire and actually have more money now to do really cool things in their communities and in their lives. So at the end of the day, folks, we would encourage you all, talk to your advisor. A lot of these technology, you're probably starting to hear more and more about them. The income tool that John mentioned is part of our subscription model, which we've had a lot of clients who have been massively benefited from working there. So definitely reach out and talk to your advisor. Now, John, we've covered a lot of ground here. We try to keep it high level, right? You can really go down into the weeds with a lot of these conversations, and we're happy to do that with each and every one of you. But John, when you think about just that transition from retirement, what really, at the end of the day, is the most important thing for people to keep in mind?
Yeah, it's really, I think the most important thing, this is myself. I mean, I'm 56 years of age. And so I'm at that point now where I'm also kind of considering what do things look like in the future. And what I've done is I've surrounded myself with tax attorneys. I've surrounded myself with CPAs, with CFAs, with technicians, with individuals that are having alternative investments to give me counsel as far as how I manage my personal assets. What I encourage all of our clients to do is the exact same thing. Understand your goals, understand what you want to accomplish, and then start to surround yourself with high quality technicians that you're able to go to them and get counsel about how to put together an entire holistic plan that looks at all those areas to help you have a higher probability of reaching your goals. And that's what we've created at Creekmur Wealth Advisors, is that we have gone out and found best in class providers from the legal standpoint, from wills and trusts and estate planning, from the tax planning, from financial planning, from alternative investments, from traditional technical analysis. We've gone and acquired those firms. We brought them together under one umbrella to offer you the best solutions. And then, Drew, the next part of that then is to make those people available to all of our clients. So coming up on the 23rd of April, we have True Wealth Live. It's going to be live and in person in Central Illinois this year. But we're also broadcasting live on our YouTube channel. And we'd encourage everybody anywhere in the country, or even actually outside of the country, if you can't make it to East Peoria, definitely get signed up to be there. It's a gated viewing, just so you know. You need to make sure you have the passcode to get in. But you'll be able to view the presentations, and we'll be talking about all the things Drew and I talked about today. We'll be going into a deeper dive on those topics for one straight hour. It's going to be a powerful evening, so you don't want to miss it.
Yeah, absolutely. So folks, make sure you sign up for True Wealth Live. We're really excited about it. Hopefully we'll see a lot of you there or see you joining us online. Otherwise, if you have any questions about anything we talked about today, reach out to your advisor, anyone on our team, and we're more than happy to help. Thanks for the time, y'all. Talk to you soon.